Hello and welcome to our interview series where we bring you valuable insights from top fund managers across leading AMCs. Joining me and my colleague Chirag today is Sailesh Raj Bhan. He's CIO-Equity Investments at Nippon India Mutual Fund. Welcome, Mr. Bhan.
Thank you. Thank you for having me.
Good to have you here, sir. Now, you've spent over 2 decades navigating the ups and downs of the equity markets. So, if you could go back in time, what would you tell your younger self about investing, and what would your younger self be surprised to learn about you today?
I think it's a very interesting question. I think simply put, I would say that make volatility your friend, because that I think is what will really determine, what kind of returns you really earn. You have to actually take advantage of the volatility rather than be caught on the wrong side of it over the cycle. I think that is one benefit for equities. They allow you to possibly position yourself well in different market conditions, and allow you to take advantage of extreme price fluctuations will happen. So volatility is a friend. It's not to be worried. It's actually welcome, because that is the only thing that enhances returns. Otherwise, a lot of people are fighting in the same market to earn good returns for their investments.
Sir, over the years, how has your investment philosophy evolved to handle the complexity of managing large equity base as you manage right now at Nippon? Are there any principles you swear by that hasn't changed over the period of time?
So it's been a journey, right? I mean, when you start off managing money, and as scale grows, you actually adjust and tune yourself to what the reality is. I think there are a few core principles which don't change with time. One for us has been to not overpay for growth. Just be very careful in what you're paying, because your starting price itself determines a lot of longer term real investing returns, right? Second is also to take risk by understanding what risk you're taking. Taking any blind risk is it only adds to a challenge. It looks good in a bull market. It just does not enhance returns over periods of time, right? And as a philosophy, we have always focused on buying growth companies with the underlying framework that buy it at reasonable prices. Don't, like I said, disproportionately overpay for growth. So a few principles like this have allowed us to live through different cycles and capture market returns. And like I started this conversation on volatility, I think if there is one single tool which can really enhance your returns, is the volatility which happens in markets, where your conviction gets tested. And if you are on the right side of the understanding of the investment and the industry, I think the outcomes can be very, very good.
Sir, but the strategy has remained means same across the period over the period of time, or it has evolved depending on the dynamics of the market?
The core framework has remained same, because under end of the day, what are we doing? We are doing two things, boss: choosing a good business to buy and choosing what to pay for that business. So that fundamental framework has remained same. What has changed is how much cyclical nature you can carry in your portfolio. Say, for example, when you look at cyclical investing, which we do, invest in businesses which can go through large cycles. Our idea there is to choose the leaders there, so you don't add one more layer of risk of fragile balance sheet. So you end up choosing leaders there. So those kinds of nuances do come about over a period of time, but the real core is buying businesses at sensible prices and thinking medium term in everything you do. I think these two things have enabled the learnings over the time has been enabled, and these are the two frameworks which continue to remain the same.
Sir, could you elaborate more on, as you mentioned, the point you bet only on the leaders of the sector particularly. Could you just share with us any few more important decision making things which you focus on while picking the stocks?
Yeah, see, there is when you're buying a cyclical sector, for example, there are always external cycles which can be longer than what you can anticipate. You can have balance sheets of companies deteriorating much, much more, because these cycles are long, they are long cycles and they last very long, right? So when you have this kind of a situation, it is better to be in companies who are leaders in those categories, and they do not miss growth when there is a recovery. When there's a recovery for that specific space, you have to own those leaders, because they will be the guys who will be willing to, or who can really capitalize on it. Most other players would actually fall off either because of the cycle which takes such a long time to recover, their balance sheets cannot withstand that, or they are not in a position or not prepared enough to capture. So I think it's a question of in cyclicals, choose leaders in the bad cycle, because that is where I think the best risk reward is available. The same is valid for cyclicals like the hotel sector as well, like every other area where, because the maximum amount of profit pool which is there is captured by leaders in the recovery. And that is what we would really attempt to capture. Plus, you reduce the risk of these companies not existing, because if the leaders don't exist, 98% of the other companies will not have any right to exist or right to win there.
Right now, geopolitics, domestic slowdowns, market corrections, the current landscape is certainly not for the faint-hearted. So, what is your outlook on Indian equity markets in this perfect storm?
Yeah, markets have done exceedingly well the last 3, 4 years, right? And when you have come to a place where now the starting valuations, in fact, even for the last 12 months and now, are not very cheap. And when starting valuations are not high and the variables, the external variables you have talked about are fairly significant, it becomes it's not going to be an easy market for any of the investors now. Uh, our case is each of these have certain legs to go. I think the first is the domestic slowdown, which you talked about, right? I think some of it is certainly a cyclical kind of a slowdown, which is coming about because of the last 2 quarters where you had challenges of elections and you had extreme weather conditions in many pockets. So that did impact some kind of growth. And we were sitting on very high margins of the last year. So I think a combination of this has hurt. We think earnings which have been weak in the first half should start getting better. It takes time because it's a cycle. It has its own revival of maybe 6 to 12 months of time from here on. But I think broadly earnings which have been under pressure in the last 2 quarters should start getting better. You have the whole investment cycle in front of us. You have global growth, which was challenged for the last 2 or 3 years, actually being possibly in a better space, right? And the geopolitical challenges have lasted long enough. So I think I would bet against them getting solved in the near term rather than they becoming worse, because this is some call which we can't take with greater certainty. But I think in all probability, the pressure on earnings because of all these global factors is already in prices. So I think overall earning recovery should get better from where we stand today. It will not be immediate. It's a journey, and I think that change is what markets will look forward to. And if you are able to get the earning cycle right, I think then you are generally able to get the markets right from a medium term point of view.
Sir, do you see the recent market correction as a much needed reality check, or are we still walking on a thin ice as with regards to the valuations?
I think the single biggest thing which has happened positively for investors has been the recent correction, because the kind of euphoria which was being built in many, many segments of the market was unrealistic. When we meet investors and see that people are living with very unreal return expectations because the last 3 years have been good, the expectations are very, very high from what they can earn from stock markets. I don't think that's possible. And hence, this correction has allowed people possibly to reassess where they will put capital, what type of risk they are willing to take, and also make sure that there are alternatives to equities also, right? I mean, in the sense you can do allocation to hybrids, do allocation to other asset classes, because the real return expectations being extremely high will meet with significant disappointment. So I think the recent correction has at least given time for investors to rethink the risk they are taking. The bull market has led to a lot of misallocation of capital, people throwing money at any stock and wanting to invest. And the excesses are getting normalized. Please understand that it required a $15-20 billion of selling of foreigners in large cap stocks to have that excesses going away. That kind of selling has not happened in mid cap and small cap, so still there are excesses there which remain. Some collateral corrections have happened, but I think we are yet to see very attractive prices in mid and small cap component. But large caps are now starting to get at least sensibly priced for at least earning led kind of returns for investors.
Sir, as you mentioned, rightly mentioned that the large caps are getting, valued properly compared to the small and mid cap. And as you mentioned, that investors should look at the other like a hybrid or multi-asset kind of thing. What do you think? What should the investors do at this point of time? They should completely shun the mid and small cap kind of thing, or should they allocate more towards the hybrid balance kind of strategy?
See, incrementally, the idea is, it's very difficult to time each of these segments, right? So the investor has to follow his asset allocation. But over the last 3 years, because of extreme performances in certain pockets of the market, maybe small caps and mid caps, the weightages in its portfolio would have gone dramatically different. In fact, large cap ownership in most portfolios should have come down dramatically. And we can sense it from the flows which come into mutual funds have been much less on the large cap side in the last 3 years versus what has been in the mid and small cap side. So I think it's more a question of getting the asset allocation right and get that in terms of where you want to put in and where you stand today. Because if you have a allocation which is wrong for a different kind of a market, you end up with outcomes which are inferior. So today, the simple approach is incremental capital. Large caps is one space which is sensible to go in. Hybrids is one space which is possibly a reasonably right risk reward in the current market environment to be in. And multi-asset also as a product offers that type of outcomes to investors. So I think these are the three spaces to be in. And also a time to reassess whether you have over allocated to small and mid caps as a category because they have done so well. So outperformance would have benefited you, and your overall allocation to small and mid caps might have been way higher than normal. So maybe this is the time to even rebalance that. Even more outside investments, if long-term commitments are there, which are in a way, people carry housing loans, people carry a lot of leverage in different forms. I think with such fantastic returns of equities of the last 3-4 years, I think some of it can be booked to actually reduce your leverage, which is outside the system. So it becomes very good from a longer term risk reward for investor for his financial portfolio.
All right, moving on to some fund specific questions now. So Nippon India Large Cap Fund, it has a reputation for consistency, which is a rare feat in the active large cap space. So what is the secret sauce behind staying ahead when the benchmarks are so large?
It's been a kind market, so that's been one advantage we've had. The second is I think we've always tried to make sure that we don't play at the extremes. So our idea is to buy growth companies at reasonable prices. So a large part of our portfolio is directed towards this particular area. So we are valuation conscious at all points of time and quality conscious as always. So a combination of this has enabled us to do the outcome which is visible to you all. This fund has roughly been for 17, 18 years have been run in a similar large cap fashion. And I think we've always found that markets will have extreme phases in the interim. But if you follow this framework of growth at reasonable prices, avoid overpaying for growth at most points of time, and attempt to take the right risk, which is like what you pay and what you get for. I think these three principles have allowed us to take advantage of the opportunities. Another interesting thing is that there are a lot of narratives in large cap where people say there is no large cap alpha in large cap space. There is this. I think alpha is a construct of what the fund manager is positioning the portfolio versus the benchmark. What is the fund manager's portfolio versus where the benchmark is, and what outcomes come about it. So when we put a lot of research behind the kind of investments which we do, the probability of taking a stand versus the market and the outcomes of that probability actually move up, driven by strong research which we attempt to do. So I think there is alpha everywhere. It's about the ability to take a stand. And it does not come every month. Alpha comes over rolling periods of 2 years, 3 years. But I think there is enough and more even in the large cap space to capture. So I think these are the few frameworks and principles we have found useful while investing in the large cap space.
So, but in the last few years, we have seen passive funds rising in popularity. How do you keep this active funds relevant and ahead of of the passive funds? And is it more about art, science, or is it just about the sheer grit?
So, yes, the size of passives are rising. I think it is welcome. Look at it. As much of money as chases, this index funds are being chased with, or large money is invested in passive. So many distortions start happening on the other side. Because what is a typical index? Index is a market cap weighted construct, right? And good performers get rewarded very, very strongly. Their market caps rises and their weights in indices rises. And because of this, there are a lot of stocks which have not done in the near term are left outside or have much lesser weights. If through research you are able to identify those sets of businesses which are good but today ignored by the market because they are not in their main momentum phase, I think that allows you to get benefit of that in the returns. In fact, the larger the passive opportunity, I see a greater opportunity available for people to generate alpha in the space because that distorts markets and creates, I would say, opportunities from the imbalance which occurs. Also, both of these passive as well as active are addressing a very different problem. Passives are addressing an allocation problem, right, or solving an allocation problem, and actives are addressing the ability to generate over market returns or I would say above the beta which the market provides, right? And both of these segments have their role to play. India is still very, very young in this context, right? And I think we have got decades to go because before one or the other really wins the battle. And we also have the fact that even large companies in India are very, very small by global standards. So there is enough and more ability. Many sectors are still not there in the large cap space also. So there is enough freshness and new segments of the market yet to capture value for investors. So I think it's a very long journey. Both are equal opportunities. It's not either or. I think both of them have their role to play. And if alpha managers deliver alpha over periods of time, I see no problem. If you recollect, these were questions asked 3 years back, 4 years back. So there will be cycles where some segment does well, some segment doesn't do well. But over longer term, if you see, you will see that the value propositions which both of these segments offer are very different.
But how do you go about, because we have seen many stocks in the broader index like Sensex or top 100 stocks. There are many few stocks, top stocks which have not done well in the last 1 or 2 year, 3 years kind of thing. One of the biggest private sector bank which has done recently well, one of the biggest company in the country. So how do you look at all these things before choosing the stock?
See, large caps, because of many reasons, can have a cycle. You say, look at, say, banking space when you have larger banks sometimes underperforming and they have huge weight in indices, right? The idea is the fund managers to take advantage of these shifts, which is there, where large index weights don't deliver, but you have something which is there with smaller index weights, which can actually deliver disproportionate return. So you can actually, when you construct the portfolio, you can have a combination of both of them to allow you to outperform. Let me give you an example. Like you talked about, say, the large banks not doing well, but if you look at the recent market correction, they have significantly outperformed their indices by 10 or 15%. In fact, large cap indices, underperformers of the last, say, 2 or 3 years, some stocks have actually outperformed massively in the last 6 months. So this is the market disconnect which all of us try to capture. And it's possible to do in the large cap space as well, in the mid cap space as well, and even in the small cap space. So I think it's about, like I said, taking the right risk when you construct the portfolio, right? And choosing, very, very carefully on where you think there is a relative sensible risk reward available in the marketplace. And thanks to so many players in the market, with everybody having meaningfully different time frames and different risk profiles, you keep getting markets adjustments in markets which allow you for capturing this value.
Right now, like we discussed, the large cap fund has been a star performer, even with a relatively narrow stock universe. So, if you could share which sectors have been the unsung heroes of this success?
So over the cycle, we have seen the benefits have come from engineering and manufacturing space, which were significant overweights which we had carried. Power and utility space, which has worked very well for us. The select banking space has benefited us off late fairly significantly. These spaces have provided meaningful returns to us and actually outperformed the benchmark. We have avoided in the earlier cycle a large part of consumer names, which also benefited because those consumer names have not performed for the last 3-4 years. But now, post recent corrections, the valuations there are getting a little more sensible than they ever used to be. So I think it's about our getting those few calls right on specific sectors and the stock selection within those sectors, which has provided us alpha. So it's manufacturing, and engineering together. Then I talked about power and power utilities together, and select banks, larger private sector banks over other subsegments of the market. In the last 3 years or 4 years, we have actually also benefited from a lot of investment in public sector stocks, which had done well at extremely attractive valuations. Cyclical sector like hotels, which had benefited us significantly in the recovery cycle, because most of these businesses are up 5 times, 7 times, 10 times in a 3 year period. So it's about getting those calls right has also worked for us over a 3 year period.
Sir, as you rightly mentioned, sir, sectors which has done well, and hospitality, as we spoke in the last two interaction, that hospitality sector has worked well, and you were one of the few fund managers who had invested in during 2021 period. Which sector, as of now, gives you the conviction, as currently, which is the sector which gives you conviction to invest more?
The market stands today, right? I think the large cap bank space appears to be very sensibly valued, and from a risk reward point of view, reasonably well positioned for growth. Power utility businesses seem to be sensibly priced. Other segments might be expensive, but power utilities segments of the market seem to be sensibly priced because of the construct of the whole energy transition and the growth which is visible in the power side. Then you have select consumer discretionary QSR categories, which are today out of favor, but their valuation construct is okay. As things and demand normalize, the optionality in some of those businesses is very large. Select auto businesses have also corrected meaningfully, so that is also allowing some stock picking to be happening in those spaces. So these are the few segments of the market which are today sensibly priced, where you can actually justify putting capital to work. And I think in a normal demand environment, as we see in the next, say, a few quarters coming back, I think you will find that some of these businesses which are sensibly valued should start delivering results.
And with new investment themes, they, popping up like wildflowers, while some thrive, some fade. How do you separate real opportunities from the hype?
Yeah, see, this has been a challenge for the investors for even the last cycle and this cycle. And I think we end of the day, we only see one thing, whether these businesses in a visible 3 or 5 year period generate free cash flows or operating cash flows, which are sizable enough to justify today's market cap. And what is the possibility of that? What is the probability of doing that, or the probability of the success? So if there is a monopolistic or duopolistic player, the probability of getting good results is very, very high. But you have an extremely competitive market, say, for example, in payments and all, maybe the outcomes may not be as good. So we judge, basic idea is to see whether what is the possibility of the kind of operating cash flows we expect in the next 3 4 years, and how much are we paying for those today. So I think there are a lot of extraordinary businesses which have built moats around either very large market shares, or they are doing the business extremely efficiently. And I think, again, their market sizes are still very small. So these businesses will be very, very large. We are willing to pay premiums for those businesses. But the only thing is, are these businesses really having genuine growth, or are they overspending to buy growth? So we avoid the second segment where people are buying growth by discounting disproportionately and all that. So I think it's more a construct of right business model, ability to generate cash flows 3 5 years out, and the sizable size of those cash flows is what allows us to take decisions. Other than those, I think where we see companies just throwing money to buy growth in the shorter term and not having possibly at least a practical business model in play, I think those are clear avoids. And the new age companies, you have a combination of both of them.
Sir, coming to the multi-cap funds, the multi-cap, mid-cap juggles between the large, mid, and the small cap stocks. What's the strategy for keeping this balancing act on point?
Yeah, so this fund is close to 20 years into operation now, and we have normally worked with between 40 to 50% kind of large caps, and the balance in mid and small caps. The current construct of the fund very roughly has about 40 to 45% large caps and 55% mid and small caps. Our investing approach here is taking a stand on certain large thematic opportunities in mid and small cap categories and staying invested in them. We don't churn the portfolio very significantly, and it's more created as buying businesses which can sustain growth at maybe 10, 15, 18% for a long period of time. And when you acquire them, paying them sensible prices. Uh, given the valuation construct of the market today and where mid and small cap valuations stand versus what they have been traditionally, I think our bias is more towards large cap companies. And within mid and small caps, which we own, our idea is that we make sure that these businesses have longevity of earnings in place. So selection is based on the fact that you're buying them for their underlying earning growth rather than just the price movement, which may happen because of near-term demand and supply. Because a lot of these businesses you have to hold for a long period of time to really benefit out of it. So select themes are chosen, which manufacturing has been a theme which has benefited us in the last few years. Likewise, QSR is a theme which we have invested meaningfully. So I think these themes are chosen and held for 3 years, 5 years, 10 years to really capitalize on.
Sir, despite the structure of the market, you keep the same like 60% kind of 50-60% in large cap and remaining the small cap, or it changes depending on the market condition. If there is a sharp correction and valuation turns attractive for the mid and small cap, are you willing to bet higher in these segments?
Yeah. So today the valuation construct doesn't allow that to happen. But if you have meaningful corrections like you talked about, I think we certainly would add on to mid and small cap positions. But I think we are still some time away from those spaces. In fact, most of the correction has actually happened in the large cap space because of significant selling, right? And some correction has started to happen or happened in mid and small cap as well. But I think the valuation differentials are still very large between these two categories. And hence, at an appropriate time when you have opportunities there, I think we can have reallocations more towards small and mid cap as well. But today is the time to be biased on large caps.
Okay. So while you are biased towards large caps, given the inherent volatility of mid and small cap investments, particularly in multi-cap fund, what are the risk management strategies do you employ to safeguard investors' capital during market downturns? And if you could also share any recent examples where these strategies proved effective.
So we run a reasonably diversified portfolio so that it's effectively multi-cap is running with three portfolios, right? One large, one mid, one small, right? That is one. Second is, see, the only real risk mitigation measure is what price you pay to buy those businesses. I think valuations is possibly the most least understood risk construct, right? So one, keeping diversification there and being very sensible on what you're paying to buy those businesses. And having a horizon of 3 years and 5 years, at least when you start taking a decision on investing in those businesses, because that allows us to at least within the selection process eliminate a lot of fragile businesses very comfortably. And the longevity of those businesses is what determines our long-term return. So when we choose businesses, the idea is this business should exist beyond the next 10, 20 years. Do you have that kind of a visibility because you're putting a lot of capital to work? And once you have that in play, are you paying a sensible price to buy those businesses? So we put this as primarily fundamental risk constructs which allow us to choose. In addition to that, we run a diversified portfolio, check whether sizing is right, whether are we on a liquidity profile wise, how do we stand? So we do a lot of processes to understand what is the liquidity construct of the portfolio? Is it way better than the market or worse than the market, and try to improve it? But the primary thing is buying a business and thinking that it will last 10, 15 years and you get in at a reasonable price and stay there. I think there's nothing better than buying a fundamentally strong business and being able to stay there for the whole period of time. I think that is the best risk management. I would say from a fundamental point of view, one can do it.
Sir, if I look at the portfolio of multi-cap fund, it has around 117 stocks, which could make some fund managers sweat. What's the rationale of holding such a large number of stocks? Do you see this as a long-term approach or a tactical call?
So, like I mentioned, there are three subsegments to the portfolio: the large cap, mid cap, and small cap, right? And if you look at it, it's like virtually three portfolios into one, right? And so ideally, the number of stocks will be little more than a diversified fund. So our idea is that, you will have a little larger number of stocks than a typical diversified fund, which will run 50, 60 stocks, right? Uh, Within that, you would have some tail positions which have accumulated because of IPOs, because of demergers, because of several things which have come about, and they keep getting normalized. And our end idea is the top, say 50, 60% of the portfolio is what you really delivers the kind of core long-term returns which you get. And the emphasis to keep getting the sizing right to reach that top 50, 60 stocks actually allowing for the maximum amount of return to be made. The tail actually is more a construct of there are a lot of IPOs which have come about. Some of them might be interesting from a medium term. Our quantities there wouldn't have been very large today, but some of these could be long-term opportunities for us to keep looking at them. So these increase the list a bit, but ideally we would assume that the larger construct of returns in the next few years will be a function of our holdings which we have sized appropriately.
So, sir, if I'm not mistaken, this long tail, if you if the prospects are very good, you keep on adding, you sizing up the opportunity in these stocks going forward. And if you only if you sell the stock is only based on the valuation, or are there any factors for this tail?
There are several factors when we exit. One is the valuation, right? If you find the valuations completely abnormal, to what is the realistic return expectation from that business we exited. If you find that the size of the opportunity for what we had initially thought and what is working out, the hypothesis totally changes. It's possible. It's a very dynamic market. You get your calls right, you get your calls wrong, so you have to make changes accordingly. And also, you get opportunities to consolidate into ideas where you have greater level of conviction. So you try to move capital towards your top ideas when you have the right risk reward or right valuation differential. Also, in this current market conditions, you would appreciate that the impact cost of buying and selling stocks has been very, very high. So keeping the portfolio a little more diversified is a far better approach to rather than approaching it with a concentrated portfolio where you're creating an impact cost by buying your own stocks, which over the long term is not positive for the investors in your fund. So I think these are the constraints of operating in the current market conditions, which have been very strong in the last 1-2 years. But I think as opportunities come, as value differentials emerge, you actually end up choosing. See a portfolio which is concentrated, can be created when there are large differentials in multiples between different sectors. In fact, this time we have had a virtually horizontal rally where every sector has done exceedingly well, and the clear value differential and gaps don't exist. And I think as those start get existing because of the corrections we are seeing in the last 3-4 months, you'll find the portfolio getting more concentrated than what it is today. So I think it's a question of high conviction opportunities available in the market and we seizing them when market corrections allow them to do.
So keeping your extensive experience in mind, markets get volatile and emotions run high. There are mistakes that investors tend to make. What is that one misstep you see investors repeat during such times, and how do you help them keep their cool?
So I think the single biggest mistake which is being done by every investor today, large, small, mid, everybody today, is that there's a lot of misallocation of investment happening because of the returns of the last 3-4 years. So it's like a rear view decision making happening, and that FOMO factor is massive, and it is across very large net worth investors, medium sized net worth investors, and small investors. So it's common across. And when you see this happening, it generally happens in an extreme bull market like this, right? And when you see this happening, the outcomes in the next 3 years are very, very different than what people anticipate. So one, your expectations are too high and outcomes are way bad, and that creates the, I would say, sharp decline in long-term returns for those investors. So in our interactions, in our discussions with all investors, it's very clear that the end of the day, what return expectations you're coming with are very, very important, because otherwise you will take wrong decisions at wrong points of time and you don't get the full investor experience. So our communication is towards saying that if you're carrying unreal expectations, I think this is not the time to put money into equities. Within segments, if you want to go into pure sectoral funds, please don't over allocate than normal. Only put that much you can stay for 3 years, 5 years, 7 years there. For non-large cap investments, at least have a 3-year, 5-year investment horizon, because the starting point of valuations are high. So these are all critical conversations we have. And in a bull market, nobody listens. So that's a different outcome. But I think it's a question of our role is to continuously keep communicating what we think is possibly the reasonable right way to invest in these markets.
Sir, for the young professionals eyeing a career as a fund managers, what's the one thing that they should know about the job that no one talks about?
So this is a job which allows you to go wrong, right? So you should have the possibly the ability to go wrong and keep coming back again and again, because this is something where you have nothing in control. What you have in control is your approach to it, your learning to it, your process to it, right? And here you can fail every day, but still you should have the conviction and learning to keep coming back at it. I think this is, in that sense, it's an extremely engaging kind of a role. Plus, you get the best of the best learning you can get in any profession in this. Today, we can get an understanding of virtually what's happening in every industry, everywhere in the world. So, not a single day is boring.
All right, as we inch closer to wrapping up this conversation, just a few light-hearted questions. If your investment journey were a movie, what would you call it? Something like The Risk Taker's Gambit, The Calm Before the Fund, or perhaps something entirely your own?
I think it's like being normal in abnormal circumstances. So whatever fits that, because every day is a different day at work, right? I mean, it's just about carrying what you're doing today for a meaningful period of time. So I don't have a specific movie name to fit into it, but I think it's a challenge every day and opportunity every day is what I see.
Okay. And sir, last question. How do you unwind after a day of tracking the markets? Do you ever wish that stocks had a snooze button?
I think the markets themselves, they have a life of their own. They have their own excitement, right? I mean, so I think uh, we enjoy that. Actually, we thrive in that. If markets are not functioning, or you have say a one-way markets, I think that doesn't excite us. The market keeps changing, keeps giving you an opportunity. It keeps us excited. So we would prefer volatile markets, prefer markets which keep challenging us. And last 2 3 years have been one-way markets, which allow less of, I would say, opportunity for investors. You may get good returns, but you can't really create portfolios for the next 3 4 years out. So I think volatile markets are where we are tested most. So we wouldn't want a snooze button at that point of time.
All right. Well, with that, it's time for us to wrap up this chat. Thank you, Mr. Bhan, for taking the time for this interaction. It was lovely talking to you. Thanks.
Thank you so much. Thank you so much for your time.
Thank you, sir. Thank you, sir.